Hello and welcome to State Street Engage, a discussion forum seeking to share market insights and intelligence from across our global businesses.
Welcome to State Street Engage. I am Cara Brosnan, and joining me here today is Raf Chowdhury, Senior Investment Strategist with State Street Global Advisors, and from Singapore, Dan Gerard, Senior Strategist from State Street Global Markets Multi-Asset Team. We're here today to discuss the allocation of assets in the context of global markets and really to provide two perspectives on navigating market turbulence in a COVID-19 environment. So, Dan, Ralph, welcome.
Hi, Cara. Thanks for having us. Nice to be here.
Hi, Cara. Thank you very much for having us in.
No problem. Glad to have you here. So let's kick off here. Over the past few months, we've seen countries across the globe enter into complete lockdowns. We've seen markets dive into free fall. Central banks, governments respond with rate cuts, liquidity, and stimulus packages of various shapes and forms. There's also been a lot of speculation in terms of what a recovery might look like as the lockdown measures, restrictions begin to ease, bringing with it a resurgence in optimism. Obviously, it's not the first time we've seen such events take place across global markets. However, I think it's fair to say, this time it is somewhat different. So from your perspective, what makes the current environment similar to what we perhaps have seen in the past and maybe different to previous market shocks we've experienced? Raf?
It's a really good question. I think if we go back to January and the start of the year, it's amazing how much things have changed. From a GA perspective, our kind of outlook at the start of the year was really much more positive than it is now, as you would expect. But we were actually kind of thinking that, growth was going to follow on from 2019. One of the things we were looking for was really earnings to come through and support the multiple expansions that we saw last year. But we were still relatively positive. COVID obviously came around. It isn't really like any other events that we've had. There are some similarities, but it's really changed the course for markets, at least for this year. And we saw the same thing through the GFC. And that's probably the most similar in terms of when we think about similarities of previous events. From a market reaction perspective, at least, I think that the one difference is that this is almost like a much more contracted and sharper version of the impact that we saw on markets, at least in the GFC. So everything's happened a lot quicker. We've seen significant market drawdowns that have taken place over extremely short periods of time. And we've started to see some recovery, at least market recovery, not economic recovery yet. I think the key point of difference, though, is the GFC was a liquidity-driven event that centered around the banks and bank liquidity. The cause of this was really a pandemic.
Yeah.
To build on what you said, Ralph, I think there's a lot of good points in there. And the compactness of the downturn, I think, is such an important difference on this time around. Everything has happened so quickly. As you mentioned, there's been elements of that liquidity crisis. I think in the end, all crises of this nature, the fear is liquidity crisis, debt crisis, financial crisis. The difference is this didn't start out that way, as you said. It started out as a pandemic, or it is a pandemic, which means it's a willful shutdown of your economic environment to combat a public health crisis. And the difference between the GFC is we're actually doing this to ourselves for some other purpose besides business and finance, and that's survival. And this is an important difference because when you shut down an economy willfully, everything happens all at once, and then you have to start protecting the liquidity crisis from developing into an insolvency crisis within a time frame that would have taken months, maybe into weeks. And for better or for worse, and for better really, I think, is that the Fed and central banks, the BOE, BOJ, PBOC, they had all been through a financial crisis recently. So they got way ahead of this and enacted all of these measures that would have been debated had this happened 15 or 20 years ago. They didn't need to debate it this time. They knew what would happen, and they implemented those measures and prevented an illiquidity crisis. So I think that's an important difference this time around. The experience we've had in our risk models allowed us to prevent that liquidity crisis from happening. It doesn't mean we'll avoid the insolvency crisis, and I think that's probably a good part of our discussion to come.
So on that, that's a really good point. And talking about insolvency and where things are heading, I guess we kind of find ourselves searching for some quick fixes here. And you have a lot of managers that are faced with, challenging portfolios when it comes to asset allocation, bringing it back to the context of this discussion as well. What are we seeing in terms of, portfolio rebalances then in a period of large drawdowns?
Yeah, so we've had over the last couple of months, we've been having continuous conversations with clients around this. Obviously, as an asset manager, we're responsible for rebalancing of a large volume of assets. I think one interesting thing that happened was that the peak impact of this took place around quarter end, which is a standard rebalancing period for most investors. I think one interesting observation that I had from this, and so through the GFC, I was back in the UK and managing portfolios. I remember very vividly, we were having lots of conversations with clients about what to do with when these rebalancing periods were coming up, whether they were quarterly or semi-annual or whatever frequency. And at the time, a lot of them were beholden to kind of the governance structure that they had, which actually meant that they couldn't do much to adjust their rebalancing policy at the time. And I remember quite vividly having conversations with clients around it going, well, yes, we can implement a different strategy, but, we need new documentation, we need all this. And then they'd go back to their boards and, delays would happen. And eventually we'd proceed because you had deadlines. What's happened this time around, which has been quite interesting, is that we've had lots of clients that are probably through that experience previously are much more prepared for this. And so around quarter end, what we were having was a lot more conversations with clients who were ready to actually take action and adjust their rebalancing policy. And the way that they did it was quite interesting because we saw different institutions adopt different policies around this. On the whole, what we saw, and we saw this from the data and from the GM perspective as well, that given the significant drawdowns, most institutions were underweight equities, as you'd expect. And so we saw them tackle it in different ways. So interestingly, some would actually postpone it. Some actually went to rebalance early. Some actually did asymmetrical rebalancing. And by that, what I mean is that they would they sold down their fixed income, but they didn't buy back into the equities. So they were under equities, but they held off on that side of it, maintained the cash, waiting for a better opportunity to redeploy. So we saw a number of different strategies take place. But I think the key thing that it really highlighted and kind of reinforced, which often is forgotten, is the importance of a rebalancing strategy. It really brought back to focus how important it is to have something in place, and also to have a framework, if you are going to adjust that, to have a framework in place to kind of guide you on how to do that. So I think from the GM perspective, Dan, you probably comment on this, you guys see the asset flows. I think a lot of investors kind of maybe held off redeploying assets back into equities. And I think, prior to the quarter end rebalancing, most of them were probably between 5 to 10% underweight equities. I suspect, but Dan, you can probably confirm this, that most of them are probably still running a slight underweight to equities. Yeah,
and this is another interesting point on the timing of the pandemic. We came out of, we had a trade war that was just about thawing. So we had investors that weren't necessarily all in risk anyway coming into the year. They were starting to get more risk-seeking in, let's say, late December into early January as the trade war showed some signs of thawing. Immediately, we hit January and we had tensions in the Middle East with Iran. And from there, the pandemic started to build some speed. So investors, although they were looking to get more risk-seeking at the beginning of the year, they never really got there. Cash balances were already so high to begin with that probably prevented some of a steeper downturn earlier. We did start to see that sell-off in risk assets, of course, from let's call it late Jan to the early part of March. And then the liquidity crisis hit. And then people started selling securities that they didn't necessarily want to sell. That was a cash raise. We've bounced back from that period, but it's hard to call that, again, risk-seeking behavior. It was really about, I can hold on to what I want to hold on to without having to raise cash. And what happens from here going forward is going to be quite curious, with lots of plans, with lots of asset owners thinking about how, if at all, should I rethink my either strategic asset allocation given how the world has changed, or if I'm able to implement some dynamic policy that allows me to capture some of the near-term dislocations. Ralph, I think you'll have a better idea of what you're seeing in that environment. But it is, I don't think that there is probably a universal view right now on what the world looks like in 6 months, right? It's probably the most uncertainty surrounding asset classes, I think, in at least my professional career.
Yeah, no, that's definitely the case. I mean, when we're looking out kind of over the next 3 to 6 months, there's so many unknowns. We have a base case, and we have backup case B, C, D, and we have probabilities on them all. But it's so difficult to kind of outline what the future pathway is going to be because there's so many different headwinds. I think the only thing that we really know from an investor perspective is overall investor confidence is at kind of record low levels. In Global Advisors, we have our own market risk indicators. They're all record highs, indicating that it's a very uncertain, unfavorable environment for investing in. Maybe not unfavorable from a return perspective because markets can rebound quite sharply and aggressively, but from an overall risk perspective. And so when you look at things like the VIX, they've come down from 86 down to the 30s, 40s, which is a significant reduction in the level of implied volatility on equities. But think back to the beginning of the year and the VIX was at 12. Well, markets are still 3 times as risky on that metric alone, yet they're probably 60% less risky than they were a month ago. So I think that's one thing that we're seeing investors look at is kind of, you're right, it's really hard to kind of gauge the future pathway and try and forecast what returns are going to be. There's a significant lack of earnings guidance at the moment. We all know that growth is going to be negative for this year, or at least the next quarter, before we start to see a rebound. But it's all very contingent on the future pathway of COVID-19 and what we see in terms of number of new cases, the flattening of the curve, and the restarting of economies. So we're starting to see some signs of those. So Australia, for instance, is kind of, we're talking about gradual reopening. Italy just reported that they've started to put their workforce back into production. So we're starting to see some signs. Now, that's a positive, but there's also a risk with that. So when we look at places like the US, where the number of cases is still pretty high, 1 million cases, and it's such a fragmented place in terms of various states, and the same for Europe, fragmented again, which makes it a lot more challenging to kind of implement one set of rules as we have done over here in Australia. There's a lot of risks to that maybe they're reopening too quickly. So I think there's a lot of ifs and maybes in terms of how things are going to progress from a growth perspective, whether economy is going to reopen, what the impact of that is going to be. But what we do know from a investor sentiment perspective is that it's really weak, and that tends to be a fairly unfavorable environment for investing in growth assets at least.
And Ralph, on that point, I mean, are people just keeping in cash today? I mean, you said cash is at an all-time high. Or are there any safe havens out there? Are we seeing, moving to different asset classes? Maybe kind of give a bit more context on, what we're seeing there.
There's a couple of different things that have happened as a result of this. One is that there's been a natural rebalance towards the assets that most investors over the longer term want to hold. Typically alternatives tend to be a little bit more liquid, less infrequent pricing, which means that tend to be a little bit more stable. So as everything else is sold off, weights in those have increased. Within alternatives, I think we've seen a shift in terms of where people are seeking assets. So again, this does slightly depend on horizon. So longer term horizons, investors are looking for a set of alternatives that have specific characteristics, but they're also using alternatives over the short term. So from our perspective, what we've seen is a shift to, yes, cash. So people have kind of got a little bit concerned and they've moved into cash. But we're seeing quite significant shifts into assets like gold as a safe haven asset, also US dollar, Japanese yen, Swiss franc to an extent, but some of the policy intervention there is kind of limiting the Swiss franc as a safe haven asset. So we are seeing quite a significant move around within the alternative space from a tactical perspective. And the other things that they're looking at is, some people are looking at emerging markets at the moment. And maybe from an equity space, you kind of go, there's still a lot of headwinds. There were quite a few structural headwinds prior to COVID-19. We've now had COVID-19 and a big sell-off in EM. But with China coming out of this a little bit quicker and having returned to normal and kind of started to reopen the economy, there are some signs that maybe EM is somewhere to look. And so maybe a little bit more selectively, EM debt, especially where spreads are at the moment, make them look quite attractive. These are liquid market assets, but EM debt is one that most investors would think of as an alternative.
And Dan, maybe if I turn to you, I mean, any kind of thoughts on that and what you're seeing from the market side?
Yeah, absolutely. And just let's start on that alternatives side of the picture. Alternatives, the flow into private assets and alts has been something we've been seeing really since the the end of the GFC is there's been this search for yield and a search for different risk premium. And whether or not alternatives give you that different risk premium is debatable. But what they do give you is a look-through volatility because of the way that the valuations come out quarterly. You don't necessarily see that volatility intra-period. And the truth is now, there has probably been a large destruction of value in some of those private assets. I say probably because we don't know yet; they haven't been valued yet. There's some sense of as asset owners talk to their managers and get a sense of what those portfolio companies look like in a private equity sense, or what those credit portfolios look like. But we won't know for many months what that looks like. Now, that is either a positive or a negative. It's a negative because you lack some transparency, but it's a positive for a long-term investor because they don't have to make a decision about what to do yet. By the time that they need to make a decision, it could quite well be possible that public assets are actually already starting to recover quite well, and they'll be able to look right through that past period of downward performance, just like happened in public markets. And then what we'll have is a natural rebalancing into more private assets. And the reason that is because if public assets came down, we haven't quite revalued the private markets down yet. Allocations, committed capital was made months, if not years ago, before that cash was called. Then just the mathematics of that rebalance is that you'll have a higher positioning of private assets, which the whole point of illiquids is that you can't easily get out of them or can't easily sell them. I think that that's where asset owners want to be. They want to be in places where they have a larger portion of the portfolio as a long-term investor in a more illiquid portfolio. The level of that it wasn't 5%. It's probably not 25 or 30%, but it's somewhere towards that 1/5 of the portfolio range. We will see in the months to come what happens with both public and private assets. And again, as we've been pointing out, it's a lot of uncertainty about what happens. Now, what is interesting again about this pandemic is that it hasn't really changed trends. It's just accelerated trends. If we look at equity markets today are still about where they were in 2019 levels. So, just 6 or 8 months ago. It's not like we've seen some major drawdown net since we've bounced back from that liquidity crisis. But yields are much, much lower, which is a trend that we have seen accelerated, but a trend that's been ongoing for decades. And what that means for safe haven assets is that you used to be able to park your safe haven asset in something that earned a yield. It's very hard to find that at all. And anything that we would call a safe haven, you're not earning anything for it. You're literally just protecting your downside. If we do get more risk appetite, then those safe haven assets probably sell off. And I don't think yields are going up much higher from here. Doubling from 0.5% is, it's still only 1% yield, but you've doubled the rate that safe haven asset is earning. And that impacts value quite a bit.
So I guess with that, and what we're seeing in the markets with the superannuation and the pensions funds globally weathering, large drawdowns on their portfolios, and obviously, as we said, for the private assets and some of the alts, the valuations of those assets won't be around for quite some time. Is it a matter then that it'll just remain static for that period, or do we foresee any changes?
So I think Dan touched on this before, right? So a lot of these institutions have made longer term commitments to increase their exposure to alternatives. And so, Dan kind of gave a range, but currently what we're seeing is around 10 to 15% allocations to alternatives, with most planning to increase that. Now, there's some good reasons why, which the current environment and the recent market pullback and volatility have kind of reinforced again. Partly is because those attractive natures of alternatives. So the illiquidity premium that you kind of harvest and the fact that you have this look through and so lower volatility make it quite an attractive asset class. But I think one of the other reasons that we're seeing people move into alternatives, and a slightly different perspective from Dan on this, is that Dan talked about the low level of yields. Well, actually, from a real yield perspective, most real yields are negative, which means assets like gold, the cost of owning those assets is actually not as expensive as it used to be on a relative basis, which makes them much more attractive, which is part of the reason why we're seeing this greater demand for it. But there's also a more general kind of demand for alternatives, and we've seen this over the last couple of years where lots of institutions are parking money with managers, private equity or private debt, and the money's sat on the side, waiting to be deployed. But there's such an eagerness to kind of get invested with these managers that they're willing to sit there with cash on the side with these managers. Part of the reason why, and I think we forget this because, since the GFC, we've had, up until the end of last year, we had this significant, massive bull run in growth assets. And, even 2019, we saw equity returns of almost 30%. But when you look at what most institutions are forecasting for equity markets going forward on say, the next 10 years, the numbers are much more in the 5 to 6 range than they have been, or compared to what we have seen at least. And so there's a real recognition that going forward, it's going to be much more challenging to generate returns. And so that's part of the reason why we've seen this significant move into the alternate space. And I think we've seen that in some of the data with global markets as well in terms of asset holdings. So we've seen a significant increase in the level of alternate holdings. What I do think is happening at the moment, though, is there's a lot of forward planning going on at the moment. So what I mean by that is people are looking at the current environment, looking at, okay, right, I've got these liquid assets. I've lost a lot of value on my liquid portfolio. If I start getting some significant redemptions come through, how am I going to manage that? Now, they want to maintain their alternate exposures. That's where they're going to get the returns from. But I think what this is reinstated, and we saw this through after the GFC, there was a lot of focus on listed or liquid alternatives, absolute return type funds. They became really popular through the GFC. And then they kind of, over the last 10 years, have kind of fallen to the wayside a little bit because public markets have returned double-digit returns. They haven't been able to keep up. But I think what this does is it brings back the focus to liquid alternatives and how you blend that with the illiquid part of your portfolio. And so actually, I think what this is going to drive is a more holistic view of asset allocation and portfolio construction in terms of looking at overall liquidity. And I think we already do kind of see this within kind of some of the risk reporting and stuff that we do. But I think it's going to drive a greater focus on not just liquidity in silos, but liquidity of the total portfolio, especially kind of given some of the recent news stories about allowing access to superannuation and pension funds and allowing people to draw down on them. That could cause significant liquidity issues for some of these pension funds.
It's interesting, right? The whole point of asset allocation is to try to prevent drawdowns while growing all of your upside. Two concepts that are diametrically opposed. And portfolio diversity, what people don't really want to diversify their portfolios. They want diversification on the downside. They want convergence on the upside. So what portfolios are supposed to be structured for events like what we just saw. Investing is very hard. There's no doubt about it. And whether we are able to capture these relationships is something everyone is always striving to do. But we've gotten to this point now where we need to make these decisions based on new relationships that we just haven't seen before. And I think that's going to be certainly the hard part going forward is how do you adjust risk models based on brand new correlations? Do we ignore them? Do we use longer windows, shorter windows? All of this is going to be a major challenge for portfolio diversification going forward. And we talk to our clients, we're hearing all of these challenges come out with how do we think about our allocations in rebalancing in this environment, given a new covariance matrix.
Yeah, so I think you're right. That is the challenge. When we think about portfolio construction, underlying that is covariance and correlations between asset classes. And it's something we've been talking about for the last 10 years is we've built our own absolute return funds, which basically are on the premise of the fact that correlations aren't static. What this, I think, brings about is the fact that even though correlations aren't static, we always make assumptions around how correlations are going to behave through different environments across different or between different asset classes. And I think we need to probably re-examine that. And some of the advances in risk modeling, I think, will help us do that. So
great. So Dan, Ralph, it seems there's some mixed sentiments here on what the future holds. What's the silver lining here? We spoke a lot about rebalancing, asset allocation, but what can we expect in the markets? And is this China's recovery?
Well, look, there are a number of of silver linings here, and we can look at it from a different perspective. I like to think about this as almost the Titanic problem, right? And I'll be more clear on that. It's very, very difficult for societies to prepare a risk model for something they've never experienced. And people can do it, individual entities, but for a society as a whole to prepare is nearly impossible. And I say the Titanic model because, we always talk about how the Titanic didn't have enough lifeboats on it, and that it was some notion of malfeasance or fraud or something that the ship did wrong. And in hindsight, it looks like that. But in the very early days of transatlantic cruising, that's not how lifeboats worked. Lifeboats were there to ferry people from a sinking ship to rescue ships. They weren't there to float around the frozen Atlantic Ocean. So it was a cruise liner hitting an iceberg in the middle of the Atlantic was not something we had experienced before. After that, they realized, okay, well, maybe every person needs a seat on a lifeboat, and that changed. It changed the risk model in travel forever. This is the silver lining here, in a way, is that this pandemic was serious enough to make us really react and understand what can happen and what it looks like when a world needs to shut down quickly, and that maybe next time we'll do it quicker. Maybe next time we'll be a bit more prepared for that, because it will happen again, and it potentially could be more serious. In an asset sense, in an investment sense, we also will know what that means for an economy that is trying to protect the downside. As I mentioned before, the Fed, the ECB, the PBOC, BOJ, all flooded the market with new liquidity, trying to protect that illiquidity crisis. Whether that money will actually get into the real economy, if the economy is shut, remains to be seen as well. And these are the lessons that we still need to talk about. China, they were first in, trying to be first out. They are now going to see that it's very difficult to expand their economy and export economy if nobody is importing. There's an uneven side of this recovery that they will have to deal with. Is there enough domestic demand to hold them over until their trading partners are able to import their goods? And in some ways, we're exiting this pandemic crisis just the way we were entering it, with talk of a trade war again. And that is, as much as we want to talk about the silver lining, and there are plenty of good things to think about as we start to come out of this. In many ways, the dangers we saw before the pandemic are still, they didn't go away. This didn't change geopolitics in an election year in the United States. There's a lot more danger ahead as well.
Interesting. I guess it seems that challenging times remain ahead. Listen, we'll finish up there. Thank you both very much for your perspectives and insight. And thank you for listening. I hope you enjoyed the discussion today. You can find a wide range of market insights and thought leadership on statestreet.com and ssga.com. Thank you again, and we look forward to sharing new insights in the next edition.